Hi there. Pinduoduo or PDD Holdings has reported the results for the third quarter, and they were amazing. A growth rate over 94%. So the revenue year over year has almost doubled. That's amazing. And also the net income was up almost 50% to about 2.1 billion. They're expecting to grow even more in the future. They continue to invest in agri-tech, supply chain technology, and other projects. Now, as you can see, the stock price is up 14% pre-market. As they reported those amazing results, the stock price will keep going up. Now, the important thing is if we still buy the current price. Because as you can see, the stock price has declined by over 70% from its highest peak, and then it has rebounded to over 200%. So this is the best Chinese stock. They've had an amazing performance so far. And based on the analyst estimates, their earnings are expected to grow even more in the future, from 4 billion to over 10 billion by 2026. And if you calculate the fair value based on those estimates, then the stock price is still cheap at the current level. As you can see, the fair value per share is about $137. And now the stock price is around $117. So if you can trust the analyst estimates that Pinduoduo or PDD Holdings will deliver these results, over 10 billion in earnings, then you can invest in this company and take advantage of the current price. But if you want to know the risk of investing in this business, especially at the current level, then keep watching. As I said, revenue has almost doubled and also their earnings were amazing, an increase of almost 50% year over year. If you look at the revenue, you can see that they have two segments, online marketing services and others, plus transaction services. The highest growth came from transaction services, an increase of over 300% year over year. That's quite a lot. And revenue from online marketing services has increased by almost 40%. So they keep growing. They've continued to invest a lot in marketing. As you can see, also their marketing expenses have increased by over 50% year over year. So they are trying to promote their platform a lot, especially in China and international. By the way, for international, they have another platform called Temu. Maybe you've seen some ads about that platform. Moreover, Pinduoduo has a lot of cash on hand, over around 27 billion. So that's a lot compared to the market cap of over 150 billion. So everything looks great. They had an amazing performance, they keep growing, and also the analysts expect this business to grow even more in the future. As you can see, the revenue is expected to more than double in the next 4 years. But what I don't like about this business is this dilution. You can see that the number of shares has increased from 1.1 billion to over 1.3 billion in almost 3 years. And if they keep issuing more shares, but I don't know why, because they have a lot of cash plus earnings over 2 billion per quarter, so they will make more than 4 billion a year if they keep growing. But they keep issuing more shares. As you can see, year over year, the number of shares has increased. Now they have about 1.3 billion shares. This is bad because if they keep issuing more shares, let's say that the number of shares doubles in the next 5 years, then also your value will decrease over time. Now, if they keep growing and their income doubles, even though they issue more shares, then the stock price will keep going up because that growth rate will balance this dilution. But we have to be aware of this risk. Maybe they only issue more shares in the future as they have a lot of cash on hand plus earnings, over 2 billion per quarter. Now, as I said, if you value this business based on the analyst estimates, what the market expects, then the fair value may be around 170 billion for a 10% annual return. Or, as I said, the fair value per share, $137. So the stock price seems a little bit undervalued. You don't have a huge margin of safety, but you can expect a 10% annual return from PDD Holdings or Pinduoduo. Now, maybe the growth rate won't be that high. For instance, let's say that they make over about 4 billion earnings a year, and their earnings are expected to double in the next 10 years. Then the fair value will be around 72 billion. This may happen because there is a lot of competition from other Chinese companies such as Alibaba, JD, Shein, TikTok, more recently, and who knows what other competitors will appear. That's why you have to be aware of analyst estimates. They expect a lot of growth ahead, that the earnings will more than double in the next 4 years. But when you invest, you have to have a margin of safety and have conservative estimates about the future of that company. In this case, Pinduoduo. If the earnings double in the next 10 years, then the fair value will be around 72 billion or $57 per share. Now, maybe they will grow even more. Let's say their growth rate will be about 15% a year. Then the fair value will be around 100 billion. Be aware that now Pinduoduo has a larger size. The revenue is over 9 billion per quarter, almost 10 billion. That will be of about 40 billion a year. So their growth rate won't be that high in the future, because the larger a company becomes, the lower the growth rate will be. So you have to be aware of that thing. Because if you want to invest with a margin of safety, then you can rely on analyst estimates, what the market expects. You have to have a more conservative approach. That's why it's up to you how you want to assess the value of this business. As I said, if they grow by 15% a year, then the fair value will be around 108 billion. Maybe the multiple will be higher, as China economy will rebound, and they'll keep growing. Their growth rate will be over 10%, maybe 15% or 20%. But still the fair value is below the current market cap. So the current level, based on this scenario, Pinduoduo is not a great investment. Of course, if they keep growing, they continue to deliver that amazing growth rate, over 90% a year, then the stock price is quite cheap at the current level. For instance, if they grow by 50% a year, then the market cap can go to 1.4 trillion. And that will be a lot. You can easily have a 5x on this investment. This is also a possibility, but don't forget, always focus on the risk first. They have good tailwinds. China economy is expected to grow by 5% a year in the next 10 years. But now PDD holdings has become larger, and the growth rate may not be that high. Maybe they'll grow by 50% a year in the best case scenario, but as you can see, the fair value is below the current market cap. That's why you have to focus on the risk first. Don't overpay for a stock, because if you buy at the highest peak, as it happened in 2021, you can have a huge decline like this. And then you have to wait another 2 years for the rebound. And it's quite bad. You want to avoid something like this. So it's up to you how you want to invest, based on the analyst estimates, and in this case, the market cap is undervalued, a little bit undervalued, or you can make your own estimates, 50% a year, or maybe only 10%, and the fair value will be even lower, of about 90 billion. So you decide for yourself. And if you have any questions, please let me know in the comments.